So on Friday, President Trump gave an impromptu press conference, I think on the White House lawn before he was getting on the Marine One, the helicopter. And he talked to, not only did he talk about rate cuts, which have been going around, that stuff's been leaking. Larry Kudlow's been talking about it for over a week now, who's the main parrot or cheerleader. Other trumpets have been talking about it that just repeat verbatim whatever Trump says about the economy, the U.S. economy, and then also members of the Federal Reserve. But also President Trump actually talked about quantitative easing, the next QE program. So let me just read his quote, what he said. Quote, "I personally think the Fed should drop rates. I think they really slowed us down. There's no inflation in terms of quantitative tightening. It should really be quantitative easing. You would see a rocket ship. Despite that, we're doing very well," end quote. And so he's also lying about the China trade deal, claiming that progress is being made. I don't believe him on that. But this is a total 180 from what candidate Trump said. Now that he is President Trump, he is, pro-inflation, pro-quantitative easing, enormous amounts of deficit spending, aka supply-side economics. And his tweet from September 29th, 2011 was screenshotted here in the Zero Hedge article, which I will attach to you. You can take a look at it in the information section. He says, and I believe that he's correct about this, and candidate Trump also called what the Federal Reserve was doing a big, fat, ugly bubble. He said the Fed's reckless policies of low interest and flooding the market with dollars needs to be stopped, or we will face record inflation. So it is amazing how quickly people change their tune once they get into power and once it is time to get re-election. So President Trump, in addition to that, he is also working hard on getting his additional Federal Reserve Board of Governors in. He's tried to get Steve Moore through the confirmation process. I believe Steve Moore has been going to Freedom Fest, the Libertarian Conference, but he's not Austrian School of Economics. He's more of a Milton Friedman and supply-sider. He's kind of a weird mix. So he's considered a dove. He's already stated that he wants rate cuts. And here you have an additional deficit spending, and you have the Democrats and also the mainstream media and the mainstream financial media just going gung-ho against Steve Moore. Some of the character attacks on him, they literally went through all of his the court filings from a divorce he had, and supposedly he's reconciled with his ex-wife, so things are good between him and his ex-wife, and the mainstream media and mainstream financial media and the Democrats didn't care about that. They went out of their way and started leaking all the nasty stuff that was revealed in the discovery process of the divorce. Just how the left plays, mudslinging, very, very dirty tactics. And Trump is now getting another one of his good friends, Herman Cain, who I believe also worked at the Kansas City Federal Reserve. And Herman Cain in the business private sector, I think he was either CEO or chairman of Godfather's Pizza. So he does have a private sector background, and he has talked somewhat about gold, but I tend to believe that a lot of these guys that Trump is installing now are going to be more dovish, and they're going to do what Trump tells them to do. And the rumors going around, too, that Zero Hedge cited in the same article is that Trump has been trying to get Jerome Powell fired for a while now. He's been going back and forth, flip-flopping, which it was a mistake to appoint Powell as Fed chairman probably in the first place. Remember, I said in the past, and Victor Sprondio talked about this, how Trump has made an enormous amount of mistakes hiring people. So instead of hiring all of his own guys, he's tended to hire people with nice resumes and people who have had retreads of swamp creatures from the Bush administrations and other retread Republicans. So it'll be interesting to see if Trump actually gets his additional Federal Reserve Board of Governors appointed. But some of them, I think he's gotten 2 so far. But the other, he's gotten Quarles and maybe one other guy. But we'll see if Steve Moore and Herman Cain actually get approval or not. Oh yeah, Powell was already in, but he got him appointed as chairman. But, wouldn't that be funny? This will never happen, but the one person who could actually stop the Federal Reserve maybe would be Ron Paul. If we appointed him head of the Federal Reserve and then he dismantled it from the inside, but that'll never happen. I wish it would, but it'll never happen. I'm glad you guys like my economic cartoon. I was looking for a funny President Trump one, and I was going to put some dialogue bubbles that I made with Photoshop with big fat ugly bubble and then QE coming and stuff like that. But this one is so good. Hedgeye does an absolutely great work. I just added Hedgeye to the Hedgeye's YouTube channel, which has free in-depth global macro podcasts to the featured section on the Wall Street from Main Street YouTube channel. So you can see it in there. I have a lot of people's great work on the featured channel, so it shuffles. So if you just hit the reload button, you should be able to see the channel there eventually. Okay, I wanted to talk about, I was debating whether or not I should do a short video on the inverted yield curve. I looked at about 7 or 8 different articles. They're all in a single thread in the Wall Street from Main Street Facebook group. And it probably would have taken me too much time, probably hours and hours to edit things down to a 10 or 15 minute video. So it just wasn't worth the work to go through all the research I looked at on the inverted yield curve. So let me just summarize things for you guys very, very quickly. And remember, I'm not a bond market expert. Maybe I should try to get a bond market expert on. But there's been a lot of academic research since the 70s and 80s on inverted yield curve. That's really when the research started from academics and other head economists for like investment banks and others on inverted yield curve. And so the mainstream media, the mainstream financial media, and a lot of the other talking heads are parading on anyone. Their producers and assistant producers are literally looking for anyone that will come on to the TV and say that an inverted yield curve is no big deal. It doesn't matter. However, if you look at the actual research, the academic research, that's very, very thorough. It is a big deal. And that once a yield curve goes inverted, it's a leading economic indicator. However, there is a lag time. So the inverted yield curve doesn't guarantee official recession with government economic data immediately. The lag time from the leading economic indicator is from the research I've looked at, and I've read a number of research reports and also looked at quotes from a number of different economists, whether they're working for an investment bank or working in the government, is between 12 to 34 months. And the inverted yield curve has, depending upon which research reports you look at, it has an accuracy near 100%, although there was one academic research report that said the accuracy of an inverted yield curve predicting recession was only 88%. So between 88% and 100%, almost 100% accuracy. If you want to look at some of these different articles, I could attach a few of them into the information section under this live stream show when it's done. Or you can go to the Wall Street from Main Street Facebook group. There's an entire thread with all of them. There's also PDFs that you can Google and research. I think the main research on inverted yield curves, at least in the United States, has started in the 70s and 80s. So it will be interesting to see what happens. There was one weird article. The guy was actually arguing the point that the Fed is actually intentionally inverting the yield curve to create a recession, and that he thinks that that's part of the Fed's intentional policy to slow down the economy. And he actually thinks, I'm very loosely summarizing it without going into too many details, and he actually thinks that that's a good thing in this new normal. So the guy's not a libertarian. He's not an Austrian school economist. And he's saying that an inverted yield curve will maybe force people to start spending more. Hello, Casey. You ask if it's ever going to pop. Well, the way the system works with the dollar reserve now is that the U.S. can export an enormous amount of the monetary inflation and credit. So if the things do pop, it looks like it's going to start in the emerging markets or European Union or China or Canada or Australia first. The corporate bond market is also a disaster, and I'll talk about that a little bit later in the show. So there's decades of accuracy with an inverted yield curve that it doesn't immediately guarantee an official government recession, but between 12 and 34 months later, it is near 100% accuracy, depending upon which academic study you look at. If you don't want to go too far in depth into it, that's basically all you need to know. That eventually guarantees an official government recession. We see this in the real economy. So we see this with the data coming out with the global economy. And the funny thing is, Larry Kudlow, Cocaine Larry, is trying to say that the U.S. economy is fine, and the reason that they want to do the rate cuts is because the global economy is bad. And the U.S. wants to protect itself against the global economy. But as I've said many times in the past, and many of the different experts I've interviewed over the years, the global economy is so interconnected that if there's problems in China or problems in the European Union or problems in the emerging markets collectively, that no country is safe. And yet you hear this narrative, this political spin saying that the U.S. economy is doing great, but it's the global economy that's bad. And that's why the people at the Federal Reserve and President Trump and Larry Kudlow want the rate cuts. Guys, timing these things doesn't really matter. Timing these things doesn't really matter. Okay, for the average person, you don't need to worry about timing these things. If you're a hedge fund trader and there's pressure on you each month or quarter, then maybe. But the average person doesn't need to worry about this stuff. If you have cash for opportunity and you have your exposure, you have maybe some rental properties. This is not financial advice, but if I had a couple $100,000 in savings, this is what I would be doing with my own money. That you have rental properties generating cash flow, and you have gold exposure, and you have cash for opportunity in case there's a crash, and maybe you have some hedged trades on for stocks. Betting on volatility. And by the way, but when I say betting on volatility, again, do not touch the VIX. That thing is manipulated. The VIX right now is, despite all the problems we have, the VIX is down to 12.82. So despite these problems, the VIX is down. Despite the what's looking like rate cuts in the near future, quantitative tightening ending in September, Donald Trump talking about quantitative easing on Friday. Guess what? The dollar index, despite initially falling, the dollar index is back up, 97.38 when we're doing this live stream show. So, in this bizarro world, this Twilight Zone, this Black Mirror world, this dystopian world that we live in, the people in power, at least in the US, can get away with saying and doing ridiculous stuff for now. And we have Russia and China just accumulating physical gold. Russia is accumulating a lot of physical gold, I think 30 tons of physical gold in a month. And China just released new numbers. I think it's like 10 to 15, maybe even 20 tons of gold in a month. So they're accumulating smaller than Russia, but they are accumulating. And there was a research article from Zero Hedge. It might have been citing another article because a lot of articles get reposted on Zero Hedge. I was reading it on my phone a couple hours ago. And it said normally when China announces publicly that they're accumulating more physical gold, that in the past that meant that China was about ready to do another major RMB devaluation. Rude Dog says China has the upper hand on the trade deal. No, they don't. No one's going to win on this. No one's going to win on this. Trump is a... So I don't approve of any tariffs, but there is no such thing as free trade. There is no free markets, and countries routinely, when they say that they allowed free trade, they routinely manipulate their currency and exchange rates. And the U.S. has allowed in a lot of other countries. This was after World War II to help other countries repair their economy in addition to the Marshall Plan. The U.S. has allowed a lot of other countries to import their goods without any tariffs, and that helps the U.S. consumer. Meanwhile, when the U.S. exported a lot of goods, there were enormous tariffs on them. So that just proves that there's no free trade. And I think Trump has made what he... I don't approve of this, but if he really wanted to get a trade deal done, he probably should. And again, I don't approve of this, but I'm saying if he really wanted to put more pressure on the Chinese, he should have raised the tariffs again. And I'm not in favor of this. I don't want anyone jacking up tariffs, but he definitely put an enormous amount of pressure on the Chinese raising the tariffs the first time. And China was able to blame Trump for all their economic problems. So Trump said now that there might not be additional tariffs raised until 2025, but the Chinese have no need to rush to a trade deal now because things have cooled off a bit. Okay, there's all these guesses for all these economic data, and guys, it just doesn't matter. Like guessing what Q1 GDP is, these things get revised downwards afterwards. Like, look at the predictions that Peter Schiff and Dr. Mark Faber have made. They said that first, Peter Schiff said that quantitative easing would never stop. So he was wrong about that, but he was right that quantitative easing would eventually restart because we have Trump talking about it again. And we have the Federal Reserve Board of Governors, 5 or 6 of them just in the last couple months, also talking about it. So And Dr. Mark Faber, the last time I interviewed him, you could go back and listen to it. I think it was March of 2018, so it was almost a year ago. And he said in about a year that the quantitative tightening program will end and the QE program will restart. So a lot of people talk a lot of really negative things and criticism and talk shit relentlessly on Dr. Mark Faber. It's normally people from the mainstream media and mainstream financial media and very hardcore Democrats. But the guy just has a very long career of making a lot of really smart predictions. And over his career, he has a lot more correct calls than wrong calls. And saying that he's always bearish is not true, because he was buying assets when there was blood on the streets in 2008-9. He was buying a lot of stocks. He was buying a lot of rental properties in the United States, and he did very, very well for himself. Yeah, Peter Schiff is a bright guy, but he's had a lot of wrong market calls after his correct market call about the housing bubble collapsing. So Peter has been calling for quantitative easing program to restart for years. So that's one of the things he's gotten wrong. But I love Austrian school economics, but one of the problems for Austrian school economics is it's not good with timing. So it is if you're a professional money manager or a professional investor or trader, it is very, very difficult to use Austrian school of economics for your investments and trades. And normally what people do when they red pill and wake up and start learning Austrian school economics and start being very distrustful of the Keynesian economics and the mainstream financial media and the federal government's economic data is they immediately overreact and they go all into gold and silver, which in the environment we're in, where the governments and central banks and bureaucrats can change the rules at pretty much any time, and sometimes they don't even announce them to us, that is very dangerous to be all in on any one thing when the rules could change. Well, a lot of people like to day trade, Jesse. That's the problem. It's addictive. And I see this in whether it's with stock trading or trading other asset markets or even like fantasy baseball and fantasy football, because now you have professional gambling for that with money, is that people, even when they play those like fantasy sports, they drastically overtrade. And my friends who drastically overtrade, I say, well, how many trades do you hit on? And they know it's a bad number. They know a lot of the trades they make are dumb and don't work out, and they still do it anyway. And this is the problem with people. You don't back test that the stuff you're doing, your investing and trading methodology, your philosophy is actually working. Okay, most human beings are not good at that, admitting they made a mistake and changing their process, changing their methodology. So just only holding physical metal in the environment we're in, especially if you're an American citizen where the government already has a very bad tax policy on physical gold and silver, maybe one day that will change, and in certain states like Utah and I think a couple other states, that may be starting to change soon on taxation for physical gold and silver. But the federal government policy for taxing physical metal is very, very bad. It's a disincentive. So hopefully if you contact your local congressman or senator, we can get enough people to get that changed over. But right now, the way things are in place, it's very, very bad. Okay, let me just check my notes here, see if we're on track. Yeah, so we have things in place that are good long-term for gold. We have the GLD is being heavily drained. The GLD, I think just last month, there was a 20-ton drain of physical gold in the GLD. So even though the gold price hasn't moved, GLD is being drained. So I think that would be a bullish sign for me. In addition to that, we have the oil price rally, which I think it means the miners can't really cut their costs anymore. So the miners are in peril again. And I wanted to comment on this about the gold and silver mining industry. And this is why you got to be very, very careful with the individual mining stocks you buy. So if you don't want to pay for a good newsletter writer, and you don't want to do your own due diligence and research extensively in a company, you really should not be buying a lot of individual mining companies. And this is a good example. So the chairman of Barrick Gold, I think he's former Goldman Sachs. He was a high up in Goldman Sachs and they hired him. He paid himself $12 million in additional bonuses. He gave himself a big increase because of mergers and acquisitions. And the stock over the last 12 months has actually done nothing. So Barrick Gold, if you're not familiar, I covered this about 6 to 8 months ago on another live stream show. They merged with another large gold miner called Randgold Resources, and that other CEO that they brought in to run Barrick Gold was supposed to be better, but the company just has enormous problems integrating the two mining companies. And so they had to announce, because the problems are so much worse and larger than anticipated, that it's going to take 5 years to fix them. So the stock price reacted to these comments. In addition to that, this supposed superstar CEO, he has really bad heart problems, and he either just had or is about to have an additional open heart surgery, like a triple or quadruple bypass, something pretty dangerous. And then he's talked about retiring soon. And he basically said that the new Barrick Gold is so large that they have too many mines, and it's going to take 5 years to fix all the problems of integrating. Well, this is not the narrative and the press release that was sold when the two companies merged. So only months later, after the merger, it's already a disaster. And so the stock price in 12 months has done nothing. Meanwhile, you have the chairman of the board of Barrick Gold who facilitated a lot of this stuff, and he did sell a lot of assets in the past to get cash, raise cash, and try to clean up the balance sheet. So that is somewhat good. But this was a big error, and he paid himself $12 million for not helping shareholder value, and that's just basically raping and pillaging the shareholders. And so this is all too common, unfortunately, in the resource industry, especially among the largest mining companies. The mid-tier ones are also, a lot of them are also bad about this. There's an enormous amount of inefficiencies there. Maybe if you saw some mergers and acquisitions, you would see more vice presidents and other things cut. But if you see the stock price do nothing, or you see the company announce that there's all these problems, and then you go into the annual report or quarterly report, and you see that the chairman of the board or the board of directors or the senior management team is paying themselves more money despite the stock price not doing anything or collapsing, there's a big red flag. Okay, and there was another junior on this. I can't name the name, but the junior has changed its name, changed the type of assets it's bought, and the company was drastically over-marketed many times. They even paid a marketing team hundreds of thousands of dollars to pump up all their two companies. Okay, so, and everyone thought that this one was good because of how good the marketing was, and he had some key endorsements. And then I looked through the annual report, and I saw that the company had no plan whatsoever to make money for at least 10 years. It was a gold mining company at one point, and then it switched to copper, and I'm not sure what it is now because they've changed their name 3 or 4 times. And I looked through the annual report, and I saw that the guy was paying himself almost $2 million per year for losing money and diluting more shares, and just going on conferences and doing podcast interviews to promote the stock. Meanwhile, he was using the shares as currency to buy garbage assets that were 10 years or more away from production and had no hope of being economic anytime soon. If you do a little due diligence, you can figure out in about 20 or 30 minutes the company I'm talking about, but I'm not going to name names. But it's just very frustrating that the resource industry, the resource industry is always going to be like this because there's so much technical stuff. So the average retail person, just unless you spend a lot of time and or buy good newsletters, if you spend a lot of time on your own, maybe reading articles and doing your own research and learning about the industry if you think it's interesting and exciting, or you pay for the right research, you can avoid these things, but it's just really sad. Sandstorm Gold announced a new deal. This was a surprise. They announced it earlier this week. It was about a $40 million deal. It was on a near-term gold miner from America Silver, the Relief Canyon mine. So I'll just briefly give my comments. Again, this is not financial advice. I think it's a solid deal. It's not a large deal, but they structured the deal very similar to what Silver Wheaton and Wheaton Precious Metals have been doing for years, where in order to get a stream on a mine, they participated in the miner's entire capital structure. So if you don't know what capital structure means, that means all the different types of debt and equity of a company. So like at the top of the capital structure of the company is they would be at the front of the line on a liquidation event. So like senior secured debt, and then all the different types of tranches of debt And I think junk bonds, which are unsecured debt, are at the back of the line for the debt portion of the capital structure. And then you have equity portion, which is at the very, very back of the line if the company fails and there's liquidation. But Sandstorm bought some shares of this junior, and then they also loaned them some money. And then they got a stream, a pretty good stream, and then they got a royalty on it too. So on paper, this looks like another very solid deal for Sandstorm Gold. The mine already has infrastructure, and it was a producing mine in Nevada. And apparently it was near a military base, so that's what held up the permits. So they had to get approval from the U.S. military to restart the mine. So that's why there was a delay. But it looks like the mine could be built in 10 to 12 months, and so this should be pretty immediate cash flow. So Sandstorm is building a lot of near-term growth at pretty reasonable amounts of deal size, and they're adding like some pretty good diversified cash flow. So these deals, they may look good on paper, but there's always execution risk, and the management team looks pretty solid here. They're from Barrick Gold. They worked years there, and then they left and started their own junior, and Pierre Lassonde also just invested into America Silver. So overall, I think it's not a needle mover per se, because it's not a massive deal for Sandstorm Gold, but they're being very cautious here, and it's just another solid deal. So after Hod Maden, which was the enormous deal that they did like 2 years ago, the one for the super high grade and very low cost copper and gold mine in Turkey, they've been doing safer, smaller, more solid deals instead to diversify their portfolio further. But no one has more growth in their long-term portfolio over the next 10 years. There's a bunch of assets that they've acquired that have no additional capex requirements, little or no capex requirements over the next 10 years that are not in the company's cash flow projections and are not priced into the stock at all, in my opinion. I don't even think the asset Hod Maden in Turkey, I still talk to a lot of skeptical people who think that asset will never get built or the government will confiscate it. And so I don't think that asset is priced into the stock either. So there's an enormous amount of upside. Hopefully Sandstorm Gold does not get bought, because that would cap our upside. Okay, I'm just checking my notes again. Okay, lastly, I wanted to bring up that there's going to be really weird effects of central bank intervention and messing things up. So Jeff Gundlach, in one of his recent interviews, talked about how over the last 10 or 12 months, there has been a doubling in the amount of corporate bonds in the United States issued. Just an enormous amount. And a lot of it has to do because of the policies that the central banks have chosen. But if you're a value investor, or you learned conventional finance, maybe you got your MBA or you got your Chartered Financial Analyst or CFA charter, which is very hard to get, by the way, then you learned all these things like capital asset pricing model, you learned how to do discounted cash flow analysis, net present value, which is using a discount rate on all net present value is discounting all future cash flows, current and future cash flows. And normally you only do it for about 10 years, and you use like a 5% or 8% discount rate on the cash flows. But I would argue, and I know this is going to be controversial, but there's a number of people who are in high finance and hedge fund managers also that are starting to discuss this, that the discounting for these future cash flows, because of what the central banks are doing with negative interest rates, with manipulating interest rates down to zero, all these things, it's going to distort what was normal financial theories and discounted cash flow, net present value, and the capital asset pricing model. Because the reason you're supposed to discount these cash flows is because you're supposed to be able to get a risk-free return from U.S. Treasuries. So in the past, the reason that you would use a 5% discount rate on some of these cash flows was because you could get, in the past, a 5% return supposedly risk-free on U.S. Treasuries per year. Well, guess what? You're not getting a 5% return on U.S. Treasuries anymore. In fact, probably you're going to see manipulation throughout the entire yield curve at some point. Or you'll see that the federal government may start to force these pension funds to buy U.S. Treasuries for the sake of national security or for the sake of infrastructure improvements or something where there's a capped return. And globally, let me pull up my friend Daniel Lacaille's tweet because he said it best. Let me pull this up on my Twitter really quick. Give me a second to scan it through it. This is important. Okay, here we go. So he says, with 74 trillion of money supply globally and widespread low rates, more than 15 countries with inverted yield curves and $10 trillion of negative yielding bonds. So central banks believe that the solution for poor global macroeconomic data is more liquidity and lower rates. So in other words, they're trying to solve a debt problem with more debt, which is just dumb. So the reason I bring up like discounted cash flow and capital asset pricing model is that what the central banks are doing, there's a good argument to be made that the central banks are sending very, very wrong signals to business owners that they should continue to borrow more and more and do leverage buyouts and do mergers and acquisitions and borrow money for very risky projects that might not have a payoff at all. In fact, there may not be any future cash flows for projects that these corporations are borrowing for. But if you're a company and you know you have better cash flows, then why are they being discounted in an environment where there is no risk-free return anymore? So that's the point I'm trying to make. Oh, by the way, for the article on Sandstorm Gold, I want you guys to read. There's a good one by Adrian Hernandez that's called Sandstorm Gold Updates After the Relief Canyon Royalty Acquisition. So it's from Seeking Alpha. He's a good new article author that covers Sandstorm Gold and other companies over there. So I'll attach a link to that in the information section if you want to read about it. But he goes through the deal in more details if you want to take a look at it. Okay, well, I think that's pretty much it. I'm taking a look at my notes. I think I pretty much covered everything without going into drastic detail about the inverted yield curve. But the main point about the inverted yield curve is the mainstream financial media is going out of its way to bring on expert after expert after expert trying to say that it's no big deal. So they're finding any weeds they can to push that narrative. But the academic research, the research is very, very clear that eventually the inverted yield curve matters a lot. So you got the crazy stuff going on with Elon Musk and Tesla Motors. This is just a ridiculous soap opera. But in the immoral dystopian environment we're in, we should not be surprised that these things are happening. We should not be surprised that Jim Cramer is pumping Lyft on his stupid show, saying that it's a good growth company. Meanwhile, they have, a $20 billion market cap and lose more and more money all the time. And so they bring on anyone who is bullish Lyft, including celebrities like Chamillionaire and others. Any celebrity that they can find, any sucker that's put money into this thing, they will bring on TV. Okay, so let me take a look at your listener questions and comments. I think I covered just about everything I wanted to cover. Hi, Jesse. Thanks for joining the live chat. Glad you liked the cartoon, Diana, the economic cartoon. Oil to the moon. Jesse, if oil goes substantially higher, it will act as an interest rate increase and it will crash the global economy, just like how the oil price got to $149 a barrel in 2007. And in less than a year, that also helped crash the global economy. So in addition to the banking and housing bubble, the higher oil price did help accelerate the crash. So if the oil price were to get to 90, 100, even higher per barrel, and there's evidence that demand is increasing rapidly in China still for oil, On top of that, in the oil market, we also have that Mexico just switched over in November to being a net importer of oil after being a net exporter of oil for decades. So their Cantarell field, the production at the Cantarell field has collapsed. Next, Mexico really needs to allow private sector investment. They need to allow American and European oil companies to come in there and make investments into their oil fields. And their national petroleum company, it looks like, has wasted many, many billions of dollars in debt. It looks like Pemex is over $100 billion in debt and the money was squandered. I saw a nice research article on that. Mandingo Warrior, what are your thoughts about Saudi Aramco admitting Ghawar oil field is peaked? I talked about that on the last live stream show before I did my short little episode about the liquid fluoride molten salt thorium reactor. So go back to the last show. But basically the Saudis over the long term are diversifying out of oil. And a lot of people in the peak oil community were adamant that the Saudis were lying about their production numbers from Ghawar. So the people whose work I've been paying attention to, like Matt Simmons and Steve St. Angelo and others, were adamant that the Saudis, that those were closer to the Saudi numbers, that the numbers the Saudis were claiming 5 million barrels production every year for Ghawar were incorrect. The peak oil community has been on this for a while. Now the peak oil community has been wrong about shale, but U.S. shale oil production is in general not economic. I actually saw lies from the shale producers. They are still putting out numbers, and this is incredible. I can't believe more people aren't calling them out on their lies and bullshit and suing them because they're putting it out in publicly traded information documents. I cannot believe that the shale producers are claiming, a lot of them, that their all-in production costs for shale are between $25 and $30 a barrel. And if that were true, they would have over $20 per barrel in free cash flow. And their financial statements would be far superior. So they're going to have a crisis similar to, at some point, I don't know exactly when, but unless oil prices rise or stay at higher levels, they're going to have a crisis similar to what the gold and silver miners went through when the gold and silver miners were lying even worse about their production costs. Mining stocks going to perform this week. Not if the dollar rally is like that, probably not. We'll have to see. It depends. A lot of these mining stock moves depend if these large mining stock ETFs or mining stock mutual funds want to buy. The ETFs influence, a lot of people still aren't aware of this, but these ETFs influence a lot of markets, and it's getting ridiculous. So the Chinese government was well aware that if they could get more Chinese stocks included in the Morgan Stanley Emerging Markets ETF, that it would move the Chinese stock market higher. So there was a Wall Street Journal article on this in, I think, November or December. And so their reporters did research that the Chinese government officials were putting intense pressure on Morgan Stanley to include a lot more Chinese stocks to quadruple the amount of shares, Chinese shares, in their emerging markets stock ETF. And that's one of the reasons why the Chinese stock market has rallied. That, and maybe it's already predicting a large RMB devaluation. And there's articles coming out that the rally in Bitcoin and cryptocurrencies is another reason why the volume, the trading volume, is from Asian exchanges. And it could also be Chinese Communist Party members. Kyle Bass did superb research on this. It was in a Real Vision television interview about how even though the Chinese Communist Party members do not want their own citizens buying Bitcoin and crypto, that they put their own money into Bitcoin and crypto to protect themselves against devaluation and also to launder money out of the country. Jesse says Saudi is going to start pumping sand only. No, I disagree. What the Saudis have been doing to mask their declines in a lot of their wells, so they add new wells that produce like 1 million barrels per oil, And we don't know how quickly those new wells are going to decline or not. But the Saudis have been flooding for a while now. I don't know exactly how long, but it's been for years, according to the oil experts I follow, that they flood their wells with water. So in the short term, that allows them to maintain oil production levels, but in the long term, it does not help the well. But a lot of people are very myopic right now nowadays and only care about the short term. And this is a problem in society. So if you don't think about the long term, you're not going to make smart long-term investments. You're not going to make good investments into research and development and grow new products and services. And so you have way too many people in society, especially these corporate executives of Fortune 500 companies, and they are focusing only on the short term. You know, weekly, quarterly, monthly, quarterly, at most maybe a year or two, so they can get rich quick and get out with a golden parachute. And instead, they're leaving the companies, their companies that they ran, either still run or ran, a lot worse than they found them. And this was, General Electric was one of the major case studies of this. Okay, you're just not seeing a lot of these companies spend nearly as much money in research and development because the shareholders don't reward companies spending research and development that could take many years to produce a new product or service, even though it'll be a new industry that could make $1 trillion or more. You know, the majority of people I speak to nowadays who are in markets don't even care about that anymore. I just hear routinely people who only care about the short term now. It's just ridiculous. And as a society, it's a very bad sign. When most of the people, or all the people, almost all the people, only care about the short term. Yeah, so I don't think China has the upper hand on a trade deal. China has a neo-mercantilist economy. And my sources who spend 3 months every year in China, 3 months out of the year, every year in China, say that China is bailing out most of their factory owners. And we're seeing really bad data for shipping containers from China, etc. I'm not familiar with the gold trade note. I respect Peter Schiff as an Austrian school economist. He did wake me up when I was a stockbroker, but he is not always right. In fact, a lot of his money management and his stock picks are really bad. I can't go into it anymore, but there's been a lot of bad picks. One of my podcast listeners told me, who was a client at Europac, he put this in the comment section, that Peter Schiff's Europac firm, his stockbrokers over there, recommended an oil company. They were telling him to buy it, and it went bankrupt 2 or 3 weeks later. And he wasn't angry at the stockbrokers and at Peter's firm for recommending a company that went bankrupt only 2 or 3 weeks later. That to me is a red flag. It sends that the company, even though it has a lot of resources, is not hiring good research. People to do good research, they're cutting corners. And I can't believe if you lost $8,000 in a couple weeks on something your stockbroker recommended, that you would be making excuses for the people like that. That's just my opinion, but I would pull my money out if someone lost me that much money that quickly and then was coming up with dumb excuses. What do I think about iron ore mid to long term? I would wait. We need to see a wipeout. China is still doing a lot of central planning, so there is still a lot of overcapacity there. We need to see a wipeout. Same thing with copper. I wouldn't touch really any base metals at this point. I know there's a big supply problem in zinc, but zinc is really a byproduct metal, so I wouldn't mess with it. There's very little pure plays. North Coast Fish Chaser says audit the Fed. Yes, I agree. The Fed needs to be independently audited. They claim they're audited, but it's not true. Because the last time they were actually audited, it was a one-time partial audit, and we found out about the currency swaps. The central bank to central bank currency swaps and all the basically interest-free loans that were given out during the 2008 financial crisis. Over $16 trillion worth. To foreign banks, foreign governments, foreign central banks, and even American corporations. Okay, well, we're at 45 minutes and a lot of questions are coming in. I don't see anything in my super chat right now, so that's enough for today. It's pretty much all I wanted to talk about. If you have any additional questions and comments, you can put them underneath the video. But we live in very interesting and weird times where President Trump can literally talk about rate cuts. Other people can talk about rate cuts. President Trump can even talk about quantitative easing. And in spite of this, because on a relative basis, there are enormous problems in Europe, enormous problems in China, enormous problems in emerging markets that, despite the comments that are coming out of the Federal Reserve and President Trump, the dollar will still rise on the dollar index.